How to build wealth with passive income. Hi, welcome to Simple Investing Finance, the best place where you can learn how to manage your personal finance, recalibrate your money mindsets, and discover the many ways you can achieve financial success. If you dig these kinds of videos, feel free to like, subscribe, and hit that notification icon so you get updated whenever we upload a new video. In today's video, we are going to share with you how you can build wealth with passive income using assets to buy liabilities. OPM strategy. There are two ways to get wealthy. One option is to utilize your own funds. The second option is to utilize other people's money, or OPM, as Robert Kiyosaki likes to call it. The first option, using your own money, yields small to modest returns, takes a long time to pay off, and needs some financial expertise. The other, OPM, gives large to infinite returns, generates extraordinary money velocity, and necessitates a high level of financial expertise. Good debt or other people's money. Rich Dad's core idea of other people's money, or OPM, is an indication of great financial acumen. You may greatly enhance your return on investment, or ROI, by combining smart debt with OPM and potentially attain limitless returns. OPM is a sort of good debt. To refresh your memory, good debt is any debt that puts money in your pocket. Bad debt, on the other hand, drains funds. A vehicle loan, for example, is an example of bad debt. You pay for it on a monthly basis, but the automobile generates no money and depreciates the moment you drive it off the lot. A good debt, on the other hand, would be a loan for an investment property where the rental revenue covers the property's expenses, including the debt payment, while also producing monthly income. The disadvantage of good debt is that you may only borrow a fixed percentage of the acquisition price of an item. In our real estate example, that is often between 70 and 80% of the buying price. For the purpose of simplicity, let's take a $100,000 home as an example. A standard bank loan only allows you to borrow roughly $70,000 to $80,000 for the property. The remainder of the funds must come from another source of equity, other people's money for higher ROI. As a result, when you identify a worthwhile investment, you have two options. Use your own money or utilize other people's money for the equity required and above the loan. The more you can use other people's money, the larger your return will be if you structure the deal properly. Would anyone give you their money in this manner? Many people believe that it is a dream world in which others would just give you money to invest, but this could not be further from the truth. The truth is that most consumers don't have time to look for excellent offers. Instead, they rely on individuals with the necessary financial education, skill set, and ambition to offer them deals. What should you buy with OPM? The answer is fairly simple. Buy assets, not liabilities. Number 1. Buy assets that appreciate in value. Things that appreciate in value are those that will be worth more in the future than we paid for them. These assets do not generate revenue in the strictest sense. A classic example is real estate. Assume you purchased a plot of property on the outskirts of your city. You hope that the value of the land will rise as the city grows and expands. You wish to sell the land to a buyer for more than what you paid for it when that part of the city's real estate market grows. In this situation, the value of the land grows while you hold it. It generates little money since it is underdeveloped. There are various advantages to investing in real estate. Real estate investors make money through rental income, appreciation, and profits generated by business activities that rely on the property. With well-chosen assets, investors can enjoy predictable cash flow, excellent returns, tax advantages, and diversification. And it is possible to leverage real estate to build wealth. Passive income, consistent cash flow, tax advantages, diversification, and leverage are all advantages of investing in real estate. Number 2. Buy assets that produce income. Income-producing assets are those that will offer you a consistent cash flow throughout the duration of your ownership. The cash flow is also known as passive income. There is no further action necessary to get your income stream once you have purchased the item. This is also referred to as earning money while you sleep. An example of an income-producing asset is a bank savings account. You put money in a savings account, and the bank gives you interest on it. Your initial contribution will be worth the same tomorrow as it is now. It is not a growing asset. That deposit provides you with passive income in the form of interest. Number 3. Purchase assets that will both appreciate and generate income. Dividend stocks are an excellent example of a growing asset that also generates income. Dividend growth stocks are another name for dividend stocks. They have an extra advantage. Many corporations raise their dividends over time. As a result, dividend growth stocks provide income today. Furthermore, a greater dividend income stream in the future. Risk of using other people's money. Although using other people's money has shown to be the most effective technique for achieving your financial objectives, it is not without danger. Number 1. Investor control. You run the danger of losing control of your business when you utilize OPM to develop and extend it. Angel investors fund your company after you offer them a part in it. This implies individuals become shareholders with a voice in corporate decisions and operations. Number 2. Change of business plan. When an investor introduces new control measures, your financial strategy takes a new turn. For example, suppose you have a concept to extend your products and services to fulfill the demands of your customers, and an investor comes in with a new plan that deviates from the customer-centered strategy. Number 3. High cost of financing. Obtaining a loan from a financial institution to finance your business has an associated expense. The interest on the loan may be considerable, increasing your indebtedness, especially if your firm suffers a loss. For example, if your rentals are not yet completely filled, the mortgage loan payback may be costly. Number 4. Bankruptcy. Using other people's money to fund your business increases your chances of bankruptcy due to financial difficulty. You may find it challenging to pay creditors, especially if the firm is new to the market. OPM also puts an individual danger of severing relationships with family and friends. When you borrow money from a friend or family with the promise of repaying it after your business returns, you risk losing their faith if their returns are poor. Self-financing can be used to fund your financial progress, but it will be far more successful if you leverage other people's money. All you need to succeed in earning money using OPM is the appropriate money from the right individuals to support your business. You must also establish a goal and a vision in order to accelerate your company strategy and enhance your profits. And that's it for today's video. See you later.